Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Good day to you. It's Peter Dunn, Pete the Planner, CEO of Your Moneyline. As always, on Tuesdays and Thursdays at 2 p.m. Eastern, we gather here during these strange economic times just to check in, see what's happened, and so you can walk around kind of knowing what's going on. It's an important thing to do. There's a couple brisk news items we'll get to in a moment, but today we're talking about interest. We're talking about interest rates. We're talking about how much you pay in interest and a couple other market things as well. Here's what I would like you to know before we get started today, which we will have more information for you this Thursday's CalmCast. President Trump is issuing an executive order later today that is going to alter the car tariffs a little bit. There will still be tariffs on car imports, but I will note this, that they will not be double tariffed because of steel and aluminum tariffs that were there too. So we'll know more on Thursday. What does this mean to you? It means that if you were panicking about the car market being crazy expensive in the coming months, maybe one less crazy in there, and that's good enough for me. Market has settled down, is on a 5-day win streak since we last spoke, which is a good thing. We are still close to correction territory from a high, which brings us to our very first point of the day today. What is a correction? If you're like me, the first time you heard it, you're watching the news and they're like, hey, the market went into a correction today. And you're like, oh, thank goodness it was corrected. But the problem is correction means it falls. More specifically, it falls by 10% or more from a recent high, which begs the question, what is being corrected, right? If the market's going down and someone goes, oh, it's a correction, what is being corrected? Overvaluations. Okay. So as we've talked before, shares of stock trade in a marketplace, just like you're going to a big box store, there's products everywhere. Well, there's stocks everywhere. And when an investor goes to buy a stock, they evaluate a few different things, including like, well, does this company have a profit? And if the stock is trading or selling for such a high price in relation to the profit being generated in this example, that's called overvalued. It's like, sorry, that's too expensive. It makes no sense to buy that. That is where a correction can occur. A correction, oddly enough, this is condescending, but at least I'm being honest. Correction is actually not a bad thing, right? A correction is correcting a problem. No one wants stocks that are too expensive, so a correction brings the market cost of that back down. It's a little different from the bull and bear market that we talked about here recently on the show. Again, bear markets, when the market falls 20% or more, we're just talking a 10% with a correction. They happen at least once a year, the correction does. And by the way, it usually recovers to where it was within 4 months or so. A stock market correction should not give you any agitation within your heart and your soul. They just happen, but understanding why is important. Now, if you are interested in our next topic, sorry, it's a bad dad joke. I have 2 kids. I can't help it. I, by definition, am a dad, and my jokes are terrible. Talking interest. On Thursday, we are going to talk about the Fed. Okay, you hear about the Fed all the time. They set interest rates. They do these things. But right now, what I want to do is I want to talk to you about where interest rates are, how they impact you, and then how you can both take advantage of them while at the same time trying to avoid having them hurt you. Let's start with interest rates in general. Interest rates right now, as it relates to the Federal Reserve, the Fed fund rates are at 4.25%. Okay, so that is the cost for banks to borrow from other banks, more or less. I'm oversimplifying. This determines how much you're charged on interest for everything you buy using debt. This impacts your car loans. This impacts your mortgage rates. And to some degree, it affects how much you're paid on your bank account, or if you're borrowing from a personal loan or something like that. It is all impacted by the Fed rate. When the Fed decides to lower the interest rate, there's an impact on that. There is more home buying, more refinancing. There's generally increased consumer spending. Businesses invest more and grow and hire. So I just shared these things with you. And again, we're going to talk about the Fed more on Thursday. Those all seem like amazing things, but there's some risk that usually come with that. The primary one being inflation risk. When it cuts rates, when the Fed cuts rates to stimulate the economy, to get people spending money again and investing, it can cause major problems because then supply and demand can get thrown off, and it can start to make prices increase, which is not what we're looking for. So needless to say, as we'll talk on Thursday, the interest you pay on stuff is variable in nature, and it's often determined by the Fed. That being said, let's see where interest rates stand today. Average 30-year rate on a mortgage. So mortgages usually 30 years to pay your mortgage as standard, which is interesting because not too many decades ago, the most common mortgage length was 4 years. Can you imagine taking out a home loan and you have 4 years to pay it back? Well, that's how it used to be. Now it's 30 years as the standard. So when people talk about interest rates around homes, they always quote the 30-year conventional rate. It's just under 7% right now. Average credit card rate right now is around 20, just north of 20%, which is relatively high. As you're pretty concerned, that's a pretty high interest rate. And then the personal loan rate in the United States is roughly 12%. Now, since we're talking consumer interest rates, it is important to understand how you can take advantage of them and where they can actually jump up and bite you. If you're anything like me, in the last year or so, you've really enjoyed the high interest being paid on high yield savings accounts, because when interest rates, the Fed rate, when the interest rates are relatively high, like they are now, you can actually have your bank or any sort of savings or investment institution pay you to hold your money a pretty attractive rate. And that's what's occurred. Yes, they've come down a little bit in the last year, but still relatively high, north of 4%. Of course, if the Fed rate were to be cut, those high yield savings accounts would come down. You would not earn as much on your savings that you have in there. Here's another way to think about this too. If you currently, like me, I've got a mortgage, but my interest rate is really low, like less than 3% low. And if I have money saved in a savings account earning 4%, but I had enough money to pay off my mortgage, which was I'm only paying 2.5% to borrow, that would not make sense to do. So one thing you can do to make better financial decisions is you look, how much is your savings earning in terms of interest? And then you compare that to the amount of interest you have to pay on your debts, whether it's a mortgage or credit card. So let's take another example. Let's say I've got a credit card balance of $10,000. And in that balance, I'm paying 20% interest. And I've got more than $10,000 in my savings account, but I'm only earning 4.5%. It would make more sense to pay off the 20% credit card rate because I compared the two rates, and that helps me make decisions. That's how this works. Of course, Navigating Now
CalmCast
is a series for the participants, the people covered as an employee benefit by your Moneyline. If you have questions about this and what your mortgage rate is versus your savings, by all means, call your financial coach or just log into yourmoneyline.com, go to your account. We'll be glad to help you. For those who do not have your Moneyline as an employee benefit, boy, wouldn't this be the time to have this as an employee benefit? Talk to your HR people, have them get in touch, and we will help you. All right. On Thursday of this week, here's what we're talking about. We're talking about time in the market. Timing and the market have so much to do with each other in so many different ways. We're actually going to go with time in the market as a concept on Thursday, as well as the Fed, their role in all of this. And finally, debt to income ratio, a classic for you all. All right. Hey, if you have any questions, by all means, just let us know. So until Thursday, with some more economic updates, let's hope the winning streak continues. I'm Peter Dunn, Pete the Planner, CEO of Your Moneyline. Thanks for being with us today.